Welcome to The Explainer. Today, let's talk about a type of financing that for years had this reputation as a last resort. Something for companies that were already deep in trouble. But things are changing. With interest rates up and banks getting a lot more cautious, this tool is becoming a seriously powerful strategic weapon. It's called special situations finance.
Right now, a lot of businesses feel pretty safe. They've got cash in the bank, they're playing by the rules their lenders set, the covenants, and on paper, their whole debt structure looks solid. From the outside, everything looks golden, right?
But here's the thing about that sense of security. It can be incredibly fragile. The ground can shift under your feet almost overnight. Those doors to get new financing, they can slam shut, and the willingness of traditional lenders to take on risk, well, that can evaporate without any warning at all.
Okay, so let's dig into this comfortable illusion. Let's look at the dangers that are kind of lurking in this growing gray area between looking stable and being in real financial stress.
This is what really defines that gray zone. Being stable today is absolutely no guarantee for tomorrow. A company might not be officially in distress, but as banks start tightening their lending standards, its options could be quietly vanishing. And that is precisely why having a proactive strategy is so critical right now.
And this is exactly where special situations finance comes into play. But first, we've got to bust a major myth about what this stuff actually is.
If you asked most people on the street, they'd probably talk about distressed debt, maybe bankruptcy courts, or some last-ditch rescue plan for a company that's about to go under. But honestly, that's such a small and frankly outdated slice of the pie.
So, the old myth is that this is just emergency capital for failing companies. The reality? It's a strategic tool for healthy companies that are just navigating some kind of big event or transition. See, it's not about saving a sinking ship. It's about giving a perfectly strong ship a more powerful engine and a better map to get where it's going.
The best way to think about it is as custom-built capital. This is not some off-the-shelf loan from a bank. No, it's carefully designed from the ground up to solve a very unique problem or to seize a specific opportunity at a really pivotal moment for a company.
And its flexibility is just incredible. I mean, it can be used for everything from dealing with refinancing pressure before it turns into a crisis, all the way to funding a game-changing acquisition. It solves a huge range of strategic problems, long before the word distress is even whispered.
So, the big question is, how does this approach give a company a real, decisive edge, especially in the kind of market we're looking at now and heading into 2026?
Well, when you move early with this kind of capital, you get 4 key advantages that traditional banks just can't match. It's faster, it's way more creative, it's built to handle complexity, and most importantly, it gives you options before you're desperate for them.
Okay, theory is great and all, but let's make this real. Let's walk through 3 quick, real-world examples to see how this actually works.
First up, picture a solid company. They've got a big loan due in about a year and a half. They go to their usual bank, but the market's shaky, the bank's getting nervous, and the terms they offer are just restrictive. Meanwhile, the clock is ticking.
So, instead of waiting and getting backed into a corner, they bring in special situations capital. It gives them breathing room, it resets the clock, and it strengthens their hand. They protect the company's value because they acted from a position of strength, not desperation.
All right, next, imagine a major shareholder like a family office that needs cash. Almost all their wealth is tied up in a huge block of stock in one company. If they just dump it on the market, it'll send a terrible signal and crash the stock price. They're in a real bind. Special situations finance can come in and provide a loan directly against that stock without them having to sell a single share. The family gets the cash they need, they get to keep their valuable asset, and they don't have to make any strategic compromises. It's a truly surgical solution.
And for our last one, a smart company spots a golden opportunity. A competitor is struggling a bit, making them a perfect acquisition target at a great price. But the banks, they're just too slow and too risk-averse. All their models see are the target's problems, not the massive opportunity.
A special situations provider can look past that and underwrite the opportunity itself. They move fast, provide the capital needed to get the deal done, and bam, the company seizes the moment, expands its market share, and becomes a much stronger player in its industry.
Now, this is clearly a powerful tool, but it's also sophisticated. You can't just jump in. It requires some really careful strategic thinking before you pull the trigger. You absolutely have to weigh the strategic win against the cost, which, yes, is usually higher than a standard bank loan. You have to understand if you're giving up a piece of the company, that's equity dilution.
You have to make sure the new deal plays nicely with your existing lenders. And you need a crystal clear plan for the end game, how and when this capital gets paid back. Every detail matters.
And all of this brings us to what is, without a doubt, the single most important takeaway from this entire explainer. If you remember one thing, please make it this.
When you're proactive, when you get ahead of a problem before it becomes a 5-alarm fire, you are in the driver's seat. You get to set the terms. You call the shots. You control your company's future.
But if you wait until you're in trouble and everyone knows you're desperate for cash, you lose all your leverage. The terms will be dictated to you. You're no longer defining the structure, you're just accepting whatever you can get.
So in today's market, and especially as we look toward 2026, that choice, the choice between anticipating your needs and just reacting to a crisis, that could make all the difference. The question you have to ask is, which path are you building for?